Hey everyone, Brian Bogner and Greg Towner with Parallel Financial again. It's time for our monthly update, but this month we are going to dive a little bit deeper. Normally these updates are only 5 minutes long, but there's been a lot going on in the markets. There's been some volatility with stocks lately. We've been hearing from a few of you as well with some concerns. So we're going to go a little bit longer today, talk about a few more things, dive a little bit deeper. So sit back and relax for the next 10 to 15 minutes. Sound good? Let's go ahead and get started.
All right, thanks, Brian. Well, we do want to start with our usual chart to look at trends. A month ago when we spoke, we were breaking out to new highs and everything looked great. And now how quickly things can change. We've had a sharp pullback, particularly yesterday. But still with that, we're still right within our kind of intermediate uptrend area. So certainly damage has been done. But a couple of important things to think about here. Looking at some data from SunTrust, and they looked at all the 3% one-day declines since the market bottomed in 2009. There's been 19 of them. And in 95% of those instances, the market was higher 3 and 6 months forward. And if you go back even longer term, the market usually outperforms after such one-day declines. So we don't know that that's going to be the case this time, but certainly we want to remind investors that the old saying that the market takes the stairs up, nice gradual, and takes the elevator down. So what it's doing, while it never feels good, is not unexpected. A bottoming process usually takes time. Rarely do you come down like this and go right back up. So we don't think the end is today. Doesn't mean it's going to go down more. It might, but we think there's going to be a lot of choppiness at a minimum before we can put in a bottom. But the longer term trends are still pretty solid. And speaking of longer term, so this takes it all the way back to the market lows of '09. The reason we wanted to show this chart is because look at all these little red periods in the numbers there. That's how many corrections we've had over this time period. A bunch of them in the 5%, 10%, handful of 12, even a 19. So this is just a reminder that corrections are normal. We're going to show another chart to remind you of this later. But corrections are normal. They don't feel good. We know that. It doesn't feel good to any of us. But they are a normal part of investing, and that's important to keep in mind. One thing that we talk about a lot on these calls, Brian, is investor sentiment. We hear it all the time, whether it's phone calls from clients or emails or things we read. Sentiment is a huge thing. And this is a survey that's done every week by the American Association of Individual Investors. And this data was actually mostly done before yesterday's big decline, and yet we still saw a lot less people bullish, a lot more people bearish. Presumably these numbers are even more extreme after yesterday's sell-off. It's hard to know if these are at the worst point they're going to get. Probably not. They can always get worse. So again, it doesn't tell us we're at a bottom, but it's heading in the right direction. We like to see sentiment from a contrarian perspective. People get a little bit more negative. So what are some of the reasons that are causing this, Brian? A lot of things that you could list off, but let's start with one of the big ones, interest rates. They've been going up. This is a very long-term chart. We can see now that up around 3.25% on the 10-year is right at the long-term downtrend line. But the last year or so, we've really spiked higher. And particularly in the last couple of weeks, we really spiked up to that 3.25 level. So it's a shocking thing for a lot of investors. Like, whoa, we're over 3% now. And I like to draw the analogy with this is it takes time for people to readjust to this. As investors get used to that 3% handle on it, it's kind of like, think about when you're going to fill up your tank in gas. You're used to paying $2 something, it's not so bad, you're used to it. All of a sudden something happens and you're paying over $3. Like, whoa, this is a little shocking. Maybe you change your behavior a little bit. You got to think things over, but it doesn't take too long. You get adjusted to it and you're fine with it. And once you get up to $4 a gallon or 4% rates, that things might change there. And so, for example, if we look at the next chart, we've talked a lot about at what point do interest rates matter. I know there's a lot going on in this chart, but let's just look at the top left box. That tells us that historically, when interest rates are going up, but below 5%, stocks can go up as well. And the bottom right, when rates get over 5%, stocks tend to get hurt at that point. Now, 5% is a high number. We're coming off record low rates. I think 5 is probably a little bit high before we have to really get concerned. Back to my analogy, $5 gas would be a problem. You'd really change your behavior. Mm-hmm. So we think maybe roughly in that 4% area is where rates become more of a notable problem.
Yeah. Well, you know, along those lines, Greg, as interest rates move higher, it tends to also be an indicator that we could be experiencing higher inflation. Of course, you know, some folks here listening will remember, you know, when rates were the highest back in the early 80s, we also had record inflation during that time as well. So sure enough, as we've seen rates move higher the past couple of years, inflation has been moving up with it. And we do believe that inflation is likely moving higher just from being in some, you know, over the past 8 or 9 years here, being in just some record low numbers, that it will move higher. And, you know, just an indication of that, PPG, which is a, you know, multinational chemical firm, they make a lot of paints that you paint your house with. And also they do a lot with cars, just the whole industry that they do a lot with. But they're actually raising their prices by 10% to combat inflationary pressures. So you're really starting to see, you know, there's the producers, and then there's the actual things that, you know, we buy, the finished product. Well, those things will eventually flow through. And right now, the folks that are making these things are raising their prices. Oil, as we talked about, was you know, energy prices. As you can see, we were blessed here, 2014, 15, 16 with a big decline. Gas prices got low. Now, they haven't been necessarily off to the races, but they're steadily climbing, which actually tells us if they're steadily climbing, they're building up a nice base here, and it's likely that those costs will be moving higher. Housing, same thing. You know, after 2007-8, when, you know, housing prices crashed, kind of came down. Sure enough, we're seeing a basing now, and housing's getting more costly as well, right? These things affect us. Housing, food prices, energy prices, I don't care what you do, where you're at, they affect all of us. And those
we could spend a whole video on it, on healthcare and education costs too.
Yeah, exactly. Yeah, we're not even touching those as well. And we've all, a lot of us have been feeling the pain there too. So prices do seem to be moving higher. And then last thing here, I'll say Social Security. You know, there is an annual cost of living adjustment there. And, you know, past few years it's been pretty low. 19, it'll be almost 3% increase, which is, you know, I mean, last time we saw that, 2012. So it's been a while since we've seen increases there. So again, with inflation, those things tend to move higher.
Yeah, so when there is inflation and some things lurking under the hood there, how is the consumer? We want to know, okay, so how is the consumer positioned to handle this? Well, so far, pretty good. You know, we're at basically record low unemployment rates, certainly low for this cycle. So if you have a job, you're feeling good. If you don't have one, you should be able to get one easily, or switch to another job that's better. So job market really tight.
I like to say it's a buyer's market, right? I mean, if you're looking for a job right now, now's the time to look, because there's a lot of firms, a lot of positions out there, but so.
Yeah. Yeah, and so along with the consumer, a lot of people talk about the consumer debt situation, student loans and autos and that. And, you know, we're not saying there's not potential issues out there, but this looks at your debt payments as a percent of your disposable personal income. You can see we're at the lowest point going back to 1980. So that's a good thing. You know, you want to be able to have a good amount of income to pay off your debt, as opposed to if you see the high point there prior to the financial crisis. So again, you could always dig to find some debt issues under the surface, but by and large, pretty solid. And then lastly, on the consumer, the savings rate, you know, yeah, right there in the pre-financial crisis, only saving 3-4%, not very much. In fact, a lot of people were going into debt and taking out home equity to live a higher life than they should have. But now here we are for the last 5 years, you know, we're more in the 6 to 8% range. And you can kind of ignore that spike in 2012, 13. There was a tax law change that everybody brought a lot of income back into 2012 temporarily. But for the most part, we're in that 6 to 8% range. So, you know, in one hand, economists will say, hey, we want a lower savings rate to boost GDP, you know, people spend more. But, you know, if any of you have gone out to eat, you've seen a lot of people are out spending it as it is. So it's a good sign that they're out spending, they're still able to save a decent amount going forward right now. So shifting a little bit to the corporate side and earnings, There's been a lot of talk. Yet another reason for this recent market sell-off is has expectations gotten too high coming into this earnings season that's essentially starting right now. You can see that earnings have really ramped up this past year or so. The green bars are expecting for continued growth going into next year. We think this quarter that we're going to see about 20% earnings growth due in part to the tax cut. But I think the market had really already factored that in. So we're seeing a lot of concern. Some of the early companies that have come out have great numbers, but kind of gotten hit because expectations were even higher. So again, back to how we said about interest rates, it takes a little period of readjustment to get resettled. Along with those earnings, let's look at profit margins. At record highs, it seems like we've been reaching for a while now. And I've heard for years people saying, oh, profit margins are too high, they've peaked, they've got to go down. At some point that will probably be right, and perhaps now, because some of the things that we talked about, Brian talked about inflation, cost inputs, wages, it would make sense for profit margins to go down. But the bottom line is these companies are getting much more efficient from a productivity standpoint. They're just really finding ways to cut costs and grow earnings. So profit margins are really healthy. Are they a risk to the downside? Perhaps, but for the moment, really strong. And let's kind of wrap it all up in this one chart here, Brian. We've shown this chart or a version of it in the past, but we really think it's an important one to remind investors. This is going back to 1980. Each gray column here is one individual year. So you can see that most of them are to the upside, 29 out of these 38 years to the upside. But you can also see that they all have these red dots with red numbers. That's the intra-year decline that averaged about 14% over time. Most of the years, you had a few that were real small, but most of them were, 10, 12, etc. This year we had a 10 back in late January, early February. So corrections and intra-year declines, they happen. They're the reality of investing. And none of us know when those small corrections, like we have had earlier this year and are potentially having now, we never know when one of those will turn into one of the rare or bigger ones. So you have a risk management plan in place, you raise some cash. But the most important thing to remember is corrections are very common, and don't think every little correction is going to be the next major crisis. Very rarely are they. It can happen, but rarely are they.
Right. Yeah. And the reality is too, we've been spoiled to here a little bit, I think, too, over the past couple of years. In that, let me go back to that. We've been spoiled the past few years where we haven't really seen a lot of volatility. So we think that, volatility could come back, but that doesn't necessarily mean we're going to go into a bear market.
Exactly.
And so you just gotta keep that perspective. So let's go ahead and wrap this up. U.S. stocks still within a long-term uptrend. Investors need time to adjust for higher rates. Rates are moving higher, and it just kind of takes a while to adjust the new normal. Our economy and the consumer still remains healthy. Savings rates are good. Economy's still doing well. There's, like we said, there's always reasons to be concerned. There's always reasons that, that things may or may not look good. We factor these into our analysis every day, every week that we are managing these investments. So we're always looking at, what if scenarios, right? Well, what if this happens? What if that happens? And we have contingencies for those things. But corrections are normal. Right now we're going through a correction. That could change, but at this point it's a correction, and we're still in an uptrend. So if you have any questions or comments or anything that we can be helpful, by all means, please call, shoot us an email. We're here for you, and thanks so much for your time in listening today.